After a period of underperformance, fixed income has staged a remarkable comeback, regaining more than half of the losses that we've seen since early April. So what's behind this sharp reversal, and is it the start of a lasting trend or just a temporary bounce? And with CIO now expecting the Fed's first rate cut to happen later this year, do policymakers risk falling behind the curve? That's all coming up right now for you on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastori. Thank you so much for being with us today. I'm always happy when I have my guest here in the studio with me, Leslie Falconio, from the Chief Investment Office. Leslie, always great pleasure to have you.
Thank you.
Lots to talk about. I want to maybe start with the idea of this sort of second act for fixed income. And when we say second act, it's like beginning of April towards the end of April. And obviously, since Liberation Day, which was the day that the tariffs were announced, there's been so much since then, but that was around April 2nd. Talk about the moves in treasuries. I mean, it's been an unbelievable ride. But I wanted to talk more about the fixed income spread product. It's really done kind of a large reversal. So talk about that with us and the impact.
Yeah, I mean, there's no question. I mean, one of the things about the fixed income spread product coming into the year, and we know the sort of the tailwinds, the positives that it's had in terms of higher credit quality, lower, interest rate risk in terms of high yield, and really balance sheets being in a healthy place. So when we saw this widening happen, it was really in conjunction with what was happening in the equity market, given particularly those sectors that have a high correlation to equity, high yield preferreds. But one of the things that we were mentioning, and one of the things we emphasize, is that you don't sell during that type of heightened volatility, right? You don't sell when we see from April 1st to April 8th, right? April 2nd being Liberation Day, but from April 8th, huge swings in the Treasury market. From one Friday to the next, it was a 385 to a 457. But our emphasis was do not sell in terms of what you held in credit. And sure enough, here we are towards the end of the month, akin to the equity market, which is up 5% on the week. We have things like high yield and IG retracing almost 80% of the widening which they saw from that level on April 8th, right? And that is a big, really lesson learned in the sense that, let's be honest, the volatility is not over, right? We have progress, we have talk, we have things on the table, but nothing is necessarily written in stone. And we really don't know what's going to happen in terms of tariffs going forward or the depth, the duration that impact might have. But right now, the markets are feeling some solace. And I have high yield at 375 right now, when it was at 450, 460.
That's right.
So, I mean, you've really had a nice comeback.
Yeah, even looking at, you're looking at the yield curve now. Investors are going way further out on the yield curve, even looking at a 30-year yield. I mean, there's so much risk that's being put on portfolios because people are looking out longer. Why is that? Why do you think that they're looking out further on the curve to those 15 and 30-year treasuries versus what they're seeing now at 2s and 10s and 5s?
Because they've been the underperformer. And let me just say this. I mean, as you know, Anthony, we've been a proponent of avoiding the back end of the yield curve.
Right.
We've been a proponent
for some time now.
For
by
some
the way.
time, yeah. We've been a proponent of the yield curve steepener, regardless of you're bullish or bearish. And on interest rates, that back end was going to underperform. We stayed in the intermediate part of the curve. But to your point, that long end had really taken a pretty big hit, particularly during the time when interest rates moved up to that 457 10-year yield, and everyone got a little bit spooked about the safe haven of U.S. Treasuries. So you did have that. So I think people are willing a little bit to go into that longer end now, and we're cautious with that. And I know we're going to talk about the Fed later.
That's right.
But that's one of the reasons why we still get a little bit cautious on the long end, is that the Fed is in a really tough position right now in terms of seeing growth or labor market slow, which we'll have on Friday, and the potential of inflation staying elevated or reaccelerating.
Well, let's stay there then, Leslie, because the Fed is integral to any conversation you're having about markets, especially when we're looking at fixed income. And I know that CIO has now pushed the potential for a rate cut from June through now maybe September, but still expecting 75 basis points this year. Why the delay? I mean, obviously, I think it answers itself. There's just a lot of uncertainty, but I know you'll go into the details. But will the Fed be behind the curve then if they wait until the fall to start cutting?
I think it's going to depend on what the labor market does. Let's tackle the first question, right? Why the move to June to September? One of the reasons is to be, as we all know and everyone talks about, is obviously these tariffs do have inflation impacts. And while they may use the word transitory, we really don't know what the depth or duration is right now. And what I think Powell wants to avoid is, similar to what happened in September of 2024, you cut the Fed funds rate and interest rates move higher, right? Because all the people in the back end, the bottom vigilante is saying, no, you're reaccelerating inflation, right? Let's be honest, we've been above the Fed target rate for 5 years now, inflation rate. So I think the key component of that will be the labor market. And today we had the JOLTS data, which was a little bit weaker. We have payroll on Friday, which actually, although consensus is 150, it could come in a little weaker. We're at a 4.2% unemployment rate right now. I don't think that's actually going to move the Fed to alter its plans, though, and all of a sudden cut in May than in June. And the reason is that I think they're going to be a little bit more reactive than proactive this time around to not make the error of, reacceleration. And two, when you look at what the consumer's doing right now, as we've seen, growth is they're spending forward, right? So they're taking that forward spend, they're spending it now, right? So second quarter GDP is not actually expected to be that low because they're buying their car today with the assumption that prices are going to go up 3 months from now. So you're going to have that. And that's another reason why we moved sort of the first cut until, September. And again, as we talk about, is it the destination or is it the journey, right? The market's very bullish right now in terms of their Fed rate cuts. They're expecting 100 basis points of cuts this year. They have a July 2026 Fed fund contract at about a 298, which is at the long-term neutral rate of the Fed. That's bullish. We're not quite that bullish, though. So we're thinking that, 3 cuts this year, a cut in the first quarter of 26, but a lot of this is going to depend on whether or not that hard data starts to move towards the trending lower we've seen in the soft data, and labor is going to be the key for that.
Yeah, and well, here's the question: is recession off the table from our viewpoint? Because some economists are calling for a potential U.S. recession. We keep kind of going back and forth on whether or not that's a real reality. Stagflation also keeps coming up quite a lot. What's the potential here for either one of those two things to happen?
Listen, uncertainty creates, and unknowns create a lot of potential. We have 1.5% GDP for this year, but that, that doesn't mean that recession is completely off the table. You just don't know.
Right.
And I think that's one of the reasons too when you talk about the Fed being behind the curve. There is a possibility that they are because they're going to wait. But remember, I'm sitting at a 4.33 effective Fed funds rate. I don't need to go 25. I'll go 50. I'll just increase the amount that I'm going to cut if, in fact, they're feeling that growth or the unemployment rate rising, it becomes the bigger mandate versus inflation, then they'll cut. And I think that's what they'll end up doing, but they just won't do it until they see the data.
Right, exactly. They have to take that measured approach, as you said, to be more reactionary than proactive, which makes sense in the case that we're in right now, where there is so much uncertainty around the impact that tariffs will have, and obviously what the labor market's going to look like, what GDP is going to look like. Thanks, Leslie. I want to ask you, of course, when you're looking at your projection, your expectations for interest rates as we go towards the back half of 2025. It's hard to believe we're almost in May already. What are we looking at? Because right now the risk premium is sort of there, but are investors going to stay at that level of risk if they're looking, as we said, further out the curve? What do you expect interest rates to look like?
Well, like I said, we're still not recommending the long end of the yield curve, like that 30-year. And now I'll get to the reasons why. But listen, we came into the year with the expectation the 10-year yield would be 4.25 after the first quarter, and then 4% at the end of the year. We got a lot of pushback of that initially. Most have come on our belief, and actually we've pulled forward that level because we went to 3.85 in 10-year Treasury yields. While we're still looking for lower yields in the second half of the year because we do believe growth trends lower, not necessarily recession, but trends lower, we also realize that sooner or later the narrative is going to shift. And the narrative is going to shift from tariff to tax cut, deregulation, which could have an increase in Treasury yields, assuming that we don't see a complete fall in growth. So we still have those levels in terms of lower yields in the end of the year, but that doesn't mean that we chase, right? So actually, when we hit around the 3.85, 3.90 level in 10-year Treasury yields, we flattened out our 5-year long, if you will. So we came a little bit more taking a step back on interest rate risk, keeping what we label as neutral. And because of the fact that the market's pricing in so many Fed cuts now, it's pretty bullish.
Yeah.
You almost would take the other side of that. That would be where the incremental volatility will come from. But we think longer term 4%, but not necessarily a straight line. And when the narrative just shifts, and it will, interest rates will move higher. But the point of the matter is we buy on that dip, right? I'll go along the 10-year, I'll go along the back end, and between like 450 or 480, which is around that high of the year, that's the time that you do it. You don't do it when you're at a 417 10-year yield.
Got it. Makes sense. And by the way, the 30-year is at a 465 right now, so it's had quite a run. That yield has had a rally.
There's no question. And listen, the more the Fed postpones a cut, right, to further out, the better the back end will do.
Right, exactly.
Right? If they cut early, reacceleration of inflation concerns, back end goes up.
That's right.
If they don't, it'll keep it down.
Exactly. Before I let you go, where are you recommending investors be positioned given everything we've just spoken about?
Yeah, listen, we've recommended the high quality sectors, and there's no question during that volatile period when people were concerned our treasury is a safe haven. High quality sectors were getting hit. Those with interest rate risk really took the brunt of it, and you'd be surprised. It's surprising given the fact that what was happening with the equity market, but we did see a decoupling of that correlation. We still like the high quality right now. We still like investment grade corporates given those yields and what those yields earn on a forward-looking basis. We still like agency MBS, although volatility is not behind us for a AAA asset class and that kind of or quasi and that kind of liquidity. We like that sector. We're neutral on the 5-year. And we have an overlay of a floating rate in senior loans, which we do watch to your point of recession, right? If we really believe that we're going to recession, that's not the sector you want to go into. But we do think the Fed actually is high for longer, looking for that September, not June cut. And the asset class has actually come back fairly well because it does have a high correlation to equity. So we have part floating rate, fixed rate in the 5-year part of the curve and high quality.
Stay invested, talk to your advisor, have a little bit of a wait and see kind of feel
And
to see where we go. Don't panic sell. I told that to so many people over the course of the last month. Right.
When in doubt, zoom out.
And that's really true. You had to really look at it more from a macro perspective. Anyway, Leslie, always good to have you. Thanks for joining me.
Thank you.
Great, Leslie Falconio from the Chief Investment Office. And for more information on everything that Leslie and her team are putting out there for you and your advisors to take a look at or read, you can visit our website at ubs.com/views. That's our insights page. Lots of content there for you. And you can also follow UBS on social media, LinkedIn, Facebook, as well as Instagram. Follow the studio here at UBS Trending. Lots of content there for you to take a look at. And as always, if you have any questions about what Leslie and I spoke about today, make sure that you are continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody, and remember to keep your eyes on what's trending. We'll see you soon. Thank you.